And we're live.
Probably.
It's Value After Hours. I'm Tobias Carlisle, joined as always by Bill Brewster and Jake Taylor. What's happening, fellas?
Just living the dream, enjoying that Super Bowl 90s throwback show. I thought that was pretty good. Did you guys like that one?
Yeah. Shit was hot.
I needed more Fitty though. I could have used another couple verses from him, but that's okay.
That was good. Yeah. I watched it with the in-laws, and they were just baffled. All these like the 90s hip hop came on, and my wife was just like, yes. But no, that was only directed to the middle-aged folk among us.
Us pre-boomers.
Yeah, whatever we are.
My dad texted me after. He's like, I like Dr. Dre. I was like, where the fuck have you been since I've been bumping this shit?
Like, who are these people?
You mean 1990?
They're old men.
Yeah. It's like, hey, this guy's pretty good.
That's fun.
Yeah.
Right?
I did see a funny tweet that said that Dr. Dre's been the most believable doctor that we had on TV in a couple of years.
Yeah, 50 cents now, full dollar too. I'd say he's $2.25 these days.
Oof.
$2.50.
He did. I rewatched it. I did see how he got himself up there. He was not helped. So I give him props on that. He got himself down.
They got away when he got down though.
Yeah, at his age, I got mad respect for that.
Yeah,
I didn't realize Eminem was doing the knee thing. I thought
I didn't even see that.
Like mourning Tupac. That's how out to lunch I was on that, because he did it while Dre played the intro to the Tupac song.
That makes sense.
I found myself
because I saw the Jimmy Iovine thing, but that was cool.
Found myself really, really sad that Nate Dogg didn't come out because he's dead.
Yeah, as a hologram, or what was your plan?
I was sad about that. And then somebody mentioned, like, because I quickly tweeted that it was sad that Nate Dogg wasn't there, and they were like, "What about Tupac?" But in my head, like, Tupac's so big and has been gone so long that it wasn't really even possible for him to be out. I kind of forgot Nate Dogg was dead, and that reminded me, and I feel bad about that.
Yeah, I like California. Love that song. Still prefer Tupac's version. Dr. Dre did serviceable version of it.
Yeah, well, he just dropped his own verse.
Yeah, he just got his verse in. That's fine.
Pac's verses. Pac is sick. Was sick. His shit's still awesome.
Might still be on an island somewhere. We don't know.
I don't think that's what's going on.
Okay.
Maybe. Who knows?
How crazy would the world have gotten if he would have come out though on stage like, I'm back?
Yeah, that would have been sick. Way to announce it.
What do we got on deck for today, fellas?
Just Super Bowl talk the whole time.
Yeah, basically going to recap
sports. 90s rap.
Recap the Super Bowl. LA Rams won. Good if you're a Los Angeles.
We got Berkshire buying Fwana.
Yeah,
2 years too late. Better late than never.
And Activision too, apparently. Yeah.
Warren must have liked that Drive to Survive show on Netflix. It is pretty great.
I'm gonna go with Ted on this one.
I think it's a Ted. Yeah,
I do think it's a Ted one.
Yeah, it is a little bit late, isn't it? But anyway, good pick. JT, what do you got on deck?
I've got some veggies for us that I'm titling Agility. So we'll see. I'm actually going to need your help on this one, TC. So you're going to, you factor heavily in it.
I'm not that agile these days, but I'll try my best. What about you, Bill? What do you got?
I got some general thoughts. I'll go last.
Some riffing? Any riffing?
Yeah. Yeah, there's some riffing.
Okay, I like riffing.
JT did double duty this week. He gave me an article. I did have something else, but this is a great article, so I'm going to do it. Just funnily enough, answers I think some of the questions that we had last week. Not necessarily going to resolve them forever, but this interesting out of sample testing for the value factor. I thought that this has only just come out, this paper, but I'm pretty sure this is what Mikhail Samanov was talking about when he did his 200 years of value. It sounds very similar to it. I haven't had a chance to confirm yet, but there's a new paper. Basically, they looked at some data going way back, and so I'll talk about that a little bit.
Shout out to my MoneyGram peeps that were playing the merger arb. Good job.
Don't know anything about that.
Yes, well, people forget that I still do have some value investing in me.
Can you guys do a segment on what it's like to be a professional full-time investor? I'll tell you what it is. It's a lot of
you get your
compliance.
teeth kicked in all the time, and then you wonder if you're dumb, and then it works, and then you think you're smart, and then it doesn't work, and you think you're dumb again.
I don't suffer so much from that, but I just have a lot of compliance. Compliance is like that's what I spend the most amount of money on, and that's what I spend the most amount of time doing.
Ugh.
I spend 98%
lawyer.
of my time wondering if I'm an idiot.
What's the other two?
I don't know, masturbating about how smart I am
Sounds about right.
mentally.
Oh,
Who wants to kick it off? You want me to take Jake's paper away? Since either way, it's you, JT. So let's do the paper. The paper's called. JT sent me the Mark Holbert article. He's always great. He's picked up this paper and he's done a pretty great job with it. I just tweeted out the relevant chart. It's kind of interesting.
shout out to my man Scott for sending it to me first. So it's the network provides,
That is good.
Yeah.
The paper's called The Cross-Section of Stock Returns Before 1926 and Beyond, perhaps referencing the Fama French.
We talking about history?
Yeah, well, here's the question, right? This is the reason why it's relevant, because
dang, someone get Allen Iverson on the phone.
The original research, the sort of value research, the original stuff came out in, it was like 1992. This was the Fama French article, and it ran back to 1963. So it was a pretty short window of data that they had. And they got this value effect in there using price to book. They said value, things bought cheaply on the basis of price to book tend to do pretty well relative to the market, relative to things that are expensive. And
price to book. What a loser.
I think there are good reasons why they choose it, though. It's because it's pretty static from quarter to quarter and from year to year, whereas, low earnings don't necessarily indicate that something is cheap. They might just be, or expensive. They might just be depressed. And so,
I think it made sense back in the day. What is it to recreate a business? What is that? The F score? What am I trying to?
The Tobin's Q.
Tobin's
what the
Q,
fuck
yeah.
is it? Tobin's Q.
Do
Yeah,
you mean market
I think
value
Tobin's
versus...
Q, if you could figure out how to do that, would make sense today. But like Altria has no book, right? Because they bought in all their equity. So it's hard now with some of these more
book doesn't work.
And high earning businesses.
Everybody, it's pretty well accepted the book doesn't work. Even Cliff Asness pointed out that through that period where value was doing really badly, the value factor that did least worst was book, because it gives you the least value impact.
It was the most far away from value of the values thing, so it did better.
So it did better, funnily enough.
Least radioactive.
So these guys have the problem with any sort of in-sample testing is that what you might see is just complete luck. And so the gold standard for statistical analysis is to take the same idea and then apply it out of sample. And so we've got three potential sources of out of sample testing. We've had since that paper got published in 1992 to date. And what has happened over that period is that the value factor, the value effect, has been less good. It hasn't been as predictive through that period. It's still worked, but it's not as strong as the effect that they found in that 63 to 1992 period. And so these guys have, and then there's also international data. So you can take the same idea and apply it to any other stock exchange around the world. The criticism there is that they're too correlated. The global stock markets, even though they're different, they tend to go up and down roughly together. And then these guys have put all this stuff together by hand. So I think this is what Mikhail Samanov was referring to when he did his 200 years of value posts. These guys have gone back to 1866. So from the 63 data, Fama and French pushed the 63 data back to 1926. And then found the same value effect, but also that it was a little bit diminished. And these guys have pushed it back from 1926 to 1866, and they've done it with the only filings that were made prior to 1932. There was no requirement to file audited financial statements prior to 1932. So the filings were terrible, and they were very spotty. So the only way they can do it is using price to dividend. So they've used dividend yield, and they've found on that basis that that period of time, 1866 to 1926, was a very good time to be a value investor using price to dividend yield. It outperformed. So I think it's kind of an interesting study. I don't know that it's necessarily groundbreaking. I'm sure it took a lot of effort, and I'm glad they did it. But I think that everybody's already got there. It just confirms the price, confirm my price. Value works for people who don't like it.
Any hypotheses on the time differences of like, why did 26 to 64 or whatever it was, 63 show less value sampling, and then 64 to 92 showed yes. Since then, no. But pre 1926, why would that have showed yes? Like, what is there any commonalities in these 4 periods that we can find that would give us some illustration as to why it would work or not? Interest rates.
I don't have the answer, but I can speculate. I mean,
technological
one of the ones is
development.
60. That period of 62, whatever it was, 63 to 1992 was a period of very rapid growth in the States. So I think that does benefit. So that if you look at the Schiller, the Vitaly Katzenelson characterizes them as being like these, where Schiller Cape is peaking, that's a bull market. Where Schiller Cape tends to go sideways for an extended period of time, that's a sideways market. But that would be characterized by periods of time like 2000 to sort of 2015, and I suspect we're probably still not out of this sideways market yet, but at the moment it looks like a new bull market started in 2009, but we'll see where this all ends up. But through those periods, I think if you look at the last one was 66 to 82, and so that would have been a very good time to be a value guy, and not a good time to be a growth investor. So it's kind of caught that in the middle, maybe. I don't know.
So you think the premium has more to do with actually the other side of the bet, which was like maybe growth scuffling?
I think that value is fairly stable. Value sort of does better, but I think a lot of the performance is relative. Value hasn't done badly.
Loses a little bit of money every year, and then
value hasn't done badly over the last sort of decade. It's just that on a relative basis, it's done terribly.
Right.
63 to 82 is like when the boomers came into their own, right? Or am I a little
boomers
early on
boomers
that?
like 40. Boomers born in like the end of World War II, so it's like 45 to whatever.
60.
Yeah. So they were like
60.
23 to 40.
I think 60 is kind of the cutoff age or birth year.
That's probably right. That's the snake going through the hump going through the snake.
Yeah, I just wonder how much of that had to do with growth, like in earnings.
Value tends to do better out of the bottom. I don't know why on a relative basis, but everything, I guess
because it gets shit canned in the downturn.
Well, I don't know that. Well, that's funny because it used to be the case that everybody believed that value did better through a downturn, and that was based on like the 2002 drawdown, I think, where value skated and everything else got smashed up. Certainly wasn't the case in 2007, 2009. Got smashed up.
We're always fighting the last war.
That is true. Do you think that view that value gets smashed up is like a March 2020 view? Like value got smashed and growth skated through that?
I don't know. I guess it all depends the reason for the sell-off.
Yeah. I feel like it's also a little bit of like, where did you start? I mean, if you were expensive relative to normal valuation for your value basket, then you kind of might expect a little bit more damage, right? And vice versa.
I think that's what happened in 2007.
I think so too. Bad dispersion.
Can price to dividend yield effectively be the carry factor in stocks? Not sure what that means. Dividend yield is that's the carry. Sorry, Solo, don't understand the question.
You have to go to a smarter podcast than this one. Ask that question.
Yeah.
Yeah. Do you have any misgivings about dividend yield as a metric for measuring?
Yeah, it's, as Meb Faber will point out, it hasn't been a particularly great factor. I don't know why that is. I don't know why. And it's not very tax efficient. And I guess there are companies out there that tend to be lower growth. And so they're paying out as much of their earnings as they can in dividends because they know that's why people hold the stock. And so maybe you get to a point where you're just underinvesting in the business so that you can keep on servicing the yield, and that gets you into trouble, maybe.
Could be. I mean, if historically, it wasn't until maybe like the early 80s where anyone, aside from a few very iconoclastic, outsiders type of CEOs, where they were doing any buybacks. So that was your other outlet for return of capital to shareholders. So if it was only dividend for most of that time period before that, then kind of would imagine it would be a more realistic measurement, but less so now when you have also buybacks as a potential. And even there's probably some comp proxy statement kind of math and reasons you could look into to see why buybacks might be favored over dividends at this. Yeah. It's just the incentives for management kind of push them towards buybacks more.
They're also more tax efficient. I mean, if you sell pro rata into your buyback, you get advantage tax rates.
And you get to decide if you want the dividend or not as the shareholder, which I like.
Yeah, you can have it whenever you want too. You can time it whenever you want. Lower tax. There's a lot of good reasons for doing it that way. Yeah, why are there not more shareholder yield funds? I don't know. Meb's got a great idea with his shareholder yield, which is buybacks plus dividend yield. It should be, that's a pretty strong, it's an incredibly strong factor because it's, I think it tells you that management is doing the right thing when they're buying back when it's undervalued. If the yield is significant or the buyback yield is significant, that's a pretty good indicator that they're shareholder friendly, or they've got options struck at the right price, one or the other.
Well, I mean, I think interest rates matter here as well. So like, imagine that I lay before you as the CEO, your palette of potential options to, kind of color your own coloring book of capital allocation. And one of them is redeploy money into your own business, right? And when you look at your swath of potential investment opportunities inside your business, the lower the rates are, the more internal projects are going to pencil out as positive NPV projects. So I think, it's possible that we have pushed towards more reinvestment within the business, even sometimes maybe when it hasn't been the best idea because rates are lower. And if you are an investor on the other side of that, then you're deciding, okay, do I want the money back or do I want them to retain it? And you have nowhere else to really put the money, right? Because yields are so low with bonds or wherever else. You're like, well, shit, they might as well just keep it. And hopefully maybe they know what to do with it better than I can. I'm Tina, right? There is no alternative. And there's kind of a Tina when it comes to capital allocation as well for you.
You're heavily incentivized to do what Curate did, right? Where if you're trading really cheaply, go and issue a whole lot of bonds and get the cash in for that, and then go and arb that by buying back your stock. That's a no-brainer for a lot of these positions. Like, I don't know if we necessarily want all of the businesses in the country doing that though.
Well, that's effectively what's happened. If you look at corporate balance sheets and you look at buyback timing, there's been an LBO going on for 7 years now, but whether that is good or bad in the longer term,
we're going to find out.
Like Buffett always says about everything with economics, and then what? So I don't know if we know the answer yet to, and then what?
Just convert to Bitcoin. Don't pay it back in, or just inflate it away. Like that works too.
Yeah, it's great. Until you have to feed a family. And
You want to do your veggies, JT?
Sure. So this is a segment on agility, and it's from this terrific little book called Certain to Win by Chet Richards. And he was an acolyte of John Boyd. And until Toby comes out with his book on strategy, Grandmasters, this is a really nice starting point. So I thought I would just go through some of the stuff that I found useful in the book, and please jump in and add, because I know that you have all kinds of great stories that are going to be way better than you probably should have done this segment instead of me. But so we'll start out with let's just talk about agility in general. And I'm going to give you an example of it. My 10-year-old, who's not a math or any kind of prodigy could beat a grandmaster at chess with one simple rule modification. He gets to take 2 turns for every 1 turn of the grandmaster. Okay. Now, there's this idea called Lanchester's model, and it's sort of like what you imagine when you look at like playing Risk or something, and you have all the little pieces on the board, and they're fighting. And the idea is like it's like a red team versus a blue team, and you have the number of kind of like troops or whatever, tanks, whatever unit that you want to count, and then you have the effectiveness of that unit. So like their firing rate, things like that, like how much damage can they inflict. And so Lanchester's model is basically like, kind of playing out a little game of back and forth of, okay, we have 100 units of blue and 200 of red, and blue's firing capacity is 2x of red's. Like, seems like an even match, right? Like we have twice the firing power, but half the number. Well, it turns out you actually need 4 times the firing rate to be able to beat a 200 or, a double of the units if you actually play out the iterations a little bit. And one of the takeaways of that, which is very interesting, is that especially in a democracy where conscription to join the military may be not that politically palatable, you end up in a kind of game theory state where you have to have super effective, which also means very expensive weapons. And so if you look at how our military has evolved, and like, the F-22 Raptor program where it costs, I think, I don't know, $35 million a plane. Like you probably could have predicted that just based on this simple theory of like, well, we're not going to be adding to the number of units that much, right? Because that's not very palatable. So instead, we're going to have maximum effectiveness to be able to neutralize any opponents without a huge number. So let's shift the focus a little bit here to, when you're looking at war, it's generally speaking that the bigger army wins. However, there's all these situations where a smaller, less technological advanced side has won. And so in the 7th century, the Arabs beat the Byzantine Empire. The 13th century, the Mongols beat the Chinese. 18th century, the colonies beat the UK, right, for the American Revolution. 20th century, you had Germany versus France and England in the Blitzkrieg. Israel beat the Arabs, Vietnam versus the US, Afghanistan versus the USSR. All these situations, like how the hell did this smaller ragtag kind of bunch beat a bigger empire? And so what's going on there? And this is where we start to get into John Boyd's OODA loops, which I think we've talked about before, but the basic idea of it is that it's your operational tempo that you are waging war in. So the OODA stands for observe, orient, decide, and act. So you're taking in the battlefield, you're orienting yourself as to what's happening, you're deciding what to do, and then you're making your decision and you act on it. The faster that you can run that process over and over again, you can get ahead of your opponent as far as like just understanding the feel of the battle. And then therefore, that's how you're able to get in front of a bigger army and outmaneuver them. So Toby, want to add anything right here before I jump into some more stuff?
Just that Boyd was a fighter pilot, and reading the stories in the book, I think that it's pretty clear that Maverick and Top Gun is based on Boyd as a fighter pilot, including that pancake maneuver where they fly right by. That was one of Boyd's favorites that he pulled on a Superior in Korea.
Oh yeah, he buzzed the tower.
No, where they
the upside down, yeah.
Basically, no. Wait, they send out as a training mission when they.
I'm gonna hit the brakes and they'll fly right by.
Yeah, well, they send out. That's right. They send out.
Okay.
They send out the new guys have to fly in front, and they're being pursued by the guys who are veterans, and you always lose in that position because the other guys are already able to fire at you. But Boyd hit the brakes, and they all flew right by, and they hadn't seen anything like that before. And then he turned around and he hosed them, as he likes to call it. And so that's where all of his theories began with him as a fighter pilot, where he worked out that if you could turn faster, so maneuverability, agility was more important than speed or anything else, that if you could get inside the turning loop of the other side, which is why an OODA loop kind of that's the basis for it. Just an interesting story.
Yeah. So one thing Boyd talked about too was like the his whole career was based on energy maneuverability, like EM, and so exactly what you just said, right? Like kind of being able to make sudden changes in movement. It's not even speed, because speed implies momentum, which then it kind of has a sustainability to it that makes you predictable. So the MiG was actually like oftentimes had better characteristics than the F-86 that was often fighting against each other and like in combat training. And they figured out that what it was that the F-86 had a bubble canopy so he could observe more. Like it's the very beginning part of it. It's something as simple as like just being able to see things better was a big difference. Okay, so Boyd was trying to get these things. This is what you want to have on your side of the battle: a sense of mission, morale, harmony, and teamwork. I know, Toby, we've talked a little bit about this before in other contexts, like I think offline, but just that when you're flying a flag that is like attractive and like you could almost get the other side to join you because like they start to believe in your mission more than their other mission. Like you have the game like 3/4 won, right?
Yeah, there's a great line from Michael Dell where someone said, "Why don't you do more acquisitions?" And he said, "I try to buy all of my competitors one customer at a time." So that's a pretty good line.
Yeah. So if you can get all those things on your side, it will allow you to appear ambiguous, be deceptive, generate surprise and panic, and then seize the initiative. So they're always scrambling, right? Which then will cause your enemy to become bickering, scapegoating amongst each other, confusion, panic, rout, and then eventually surrender. And that's what happened in each one of those battles that we said historically, like where the smaller one beat the. And maybe talk a little bit about like Lawrence of Arabia at this point, because he was like a grandmaster at this, right?
It's funny how just shout out to Victor Hargrave. Thank you very much for the tip, and to Jeff Nolan. Thank you too. There was this, Lawrence of Arabia was like this towering figure for a long period of time. We've just sort of, I don't know whether it was Lawrence of Arabia, the movie was huge, and it's just sort of fallen out of common consciousness or something like that. But T. Lawrence was in World War II, British intelligence officer in Turkey, and he was sent out, and he fought with the Bedouin, or he got the Bedouin and the tribes to come and fight with him, and so they basically found a way to they fought this guerrilla warfare where they found a way to confine the Turks to their forts. And he said, "We control 99% of the land here, and they only control the forts." And so that was just he got a fever, and he had this dream, and he woke up in the morning with this guerrilla warfare, fully formed in his mind about how he was going to go and defeat them. Just great story. And then they made a great movie out of it too. No prisoners.
So Boyd actually interviewed firsthand German officers from World War II, the ones who were like largely responsible for executing the Blitzkrieg, which was a very, very effective strategy and tactics. And so there were 4 things that came out of this, and I'm going to try to say the German words here. It's going to be bad. All our German listeners, I apologize. Send your hate mail to Bill Brewster. So the first one, yeah, gmail.com. The first one is called Einheit, and it effectively means it's like mutual trust, unity, cohesion, which allows like quick communications within your group. So if you picture, like your little army unit operating together, like each other, you know what like a particular look means compared to like, if you could see just like important little cues that come only from working together and training together. So it's a huge part of having a very cohesive team. The next one is, okay, here we go. Fingerspitzengefühl, which means like, it literally means like finger, like on the pulse, like in an intuitive feel for the battle, like having your finger like right on it. So to just know like, and especially in a chaotic and complex situation, like having your finger on where everyone is and like how the battle is developing. The next one is Auftrag, which sometimes is put together with Auftrag Statik, I think is said, which just means it's like what's the mission? Like it's more actually like a contract between the superior and the subordinate, where the superior tells them, here's what we're trying to do in order to, XYZ. Like this is our bigger mission that we're trying to accomplish. Can you do this? Like, can you carry it out? And you don't tell them how to do it. You just tell them what you want to get accomplished and sort of your why behind it. And they're in charge of the how. And why that's so important is because when you're actually on the front lines, the general can't be making those kind of little decisions. Like things are happening too fast. It's too chaotic. Your OODA loop would be too slow. So to keep the OODA loop fast, you have to have some kind of processing of information on the front lines, which requires them empowerment of the people closest to what's happening. Okay. And then the last one is Schwerpunkt, I believe it said, which is a concept that it provides focus and direction to the operation. Like it's sort of like center of gravity, emphasis.
Spear point, right?
That's probably what
I think it's literally spear point.
That's probably what that is. Yeah. So that gives people this is like, maybe it's one particular unit has the most important part of the mission, like set explosives on that bridge or whatever it is. And everyone else knows that is the most important thing to be executed. That's the emphasis of this mission, but they're going to be doing a lot of other things around it to enable that to happen. So all of this stuff I think is useful in business. And it actually shows up in, Toyota's production system, like lean manufacturing. It shows up in like agile software development. All these different places, the same concepts occur again and again, and you can find them. It's basically like when groups of humans work together, this particular strategy and these principles allow for success that is much outsized compared to resources and the size of the team. So if you're in a smaller group, like you could see how this would be pretty valuable stuff to read. So I would suggest picking up Certain to Win and giving it a read.
Yeah, that's a great book. I liked the grand strategy stuff, which is just a slight abstraction back from that, where he talks about, that's one of the things that I've been talking about a little bit, the idea of harmony, which is, you were alluding to that a little bit. He's got this great line, this is Boyd, where he says something like, if you're the empire and you're fighting against the guerrillas, then you have a look at what they're trying to achieve, what their claims are, what their morality of what their argument is. And if you find that more compelling, then you should switch to the rebels. You should switch to the guerrillas. So I think that's kind of like, I think there's something humane in Boyd's analysis, and I think that there's some truth in it, where he says he's striving for harmony, which is something that Sun Tzu talks about as well, very unexpectedly, that the most harmonious group is the one that tends to succeed.
Yeah, I mean, you can sort of imagine this. I don't know. There's playing out in Ottawa today. I mean, it feels like some people may or may not be on the right or wrong side of history there. We'll see. But shout out to our Canadian friends.
Yeah, so both of my uncles are truckies, so I'm pro truckie.
Yeah, I have nothing to add.
Thanks, Charlie.
All right, mate. You wanna got anything to talk about?
Yeah, actually, there's a reasonably good segue. So, like, the mission plus morale plus teamwork that Jake was talking about. I mean, a lot of like, while you were talking the entire time, I was thinking, like, this is why Netflix carries the valuation it does, and something like Warner Discovery carries the valuation it does. And like, I think that sometimes there've been a couple comments that I think warrant at least some clarification, because I do think, like, sometimes I take shots at value guys, and it's really me just talking to my old dumb self. And if you disagree with me, that's probably good, because you're right and I'm wrong. And I'll learn it eventually. Somebody had commented on oil saying that I've dismissed it. I have not dismissed oil. I've dismissed my ability to trade an oil cycle. Okay, if you want to know my dismissal, of it. I dedicated a podcast to it with Will Thompson. You can listen to that on why it's going to take a little bit longer. My history in commodities involves me buying Intrepid Potash in 2016 as a debt restructuring. I didn't own it when it ripped from 8 to 46 recently. I bought Freeport McMoran in December of 2015. Didn't own it for any of the run. I bought Cameco in 2019. Didn't own it for any of the run. I bought.
You're just early.
Yeah, one other one so like my view of the world is I am not capable to look at commodity businesses and hold them. And I'm not even convinced, but for COVID, a lot of this commodity supply chain stuff happens. I don't know how to do the earnings power normalized. Like, if you know and you think I'm wrong, good for you. Go make money. Like, I don't care if I'm right or wrong on that. It's not my game. I have one commodity investment. I know absolutely everyone involved, and I think I know everybody's exit plan and what they're planning to do. That's the kind of commodity bet I want to make, and I reluctantly make that bet. This take on like value versus growth, I think sometimes what some listener referred to me as, I don't know. He used a fancy word for moody. I think like at the end of the day, sometimes I just don't give a shit about this debate. And it's because like I'm looking or attempting to look at, like a private equity type lens. And I know that this is super like overused and stuff, but like the stuff I own, Swedish Match, Charter, Berkshire, Microsoft, Google, like all of that is shit. At Facebook, unfortunately, recently is stuff that like I think are good businesses that have growth ahead of them, trading at reasonable valuations. People want to debate the valuation thing, fine. Short everything I own. We'll see who's right in the end. I don't care. But like as far as value versus growth and a sell-off and what protects you, I don't think that's the right discussion to have at all. I think the right discussion to have is, do you have tail hedges in place? What's your cash allocation? How much do you have bonds? Do you have anything allocated to CTAs? Those are the conversations that I think are more appropriate. So like, if I get a little moody, it's because I think sometimes like people talk past each other. And sometimes I get angry because I'm like a petulant child. Anyway, I don't know. Finally, I had a comment about indexing. And I wasn't saying like, somebody said, well, just, rather than talking about mega caps, why don't you look at small caps? I own some small caps. I'm not going to fucking talk about them because if other people get their face ripped off in them, I'm not going to own that responsibility. People can do their own work. And by the way, I've done a lot better in the bigger stuff than I have the smaller stuff. I'm open to it. I'm open to special situations. I'm open to all that stuff. But, I think like what I am trying to accomplish is, like I said, buying these businesses that I think can grow, that offer reasonable current returns. And I think that worrying about, an inflation print over the next year gets me distracted from the stuff that actually matters over the long term. If you're owning 30-year assets, I think that the next quarter's CPI print is pretty much meaningless. But I acknowledge that you run the risk of getting run over by quotational indigestion, which is why I think a cash allocation to come over the top is a more appropriate thing to discuss in that scenario. So I don't know, to the extent that people want to understand how my brain thinks, that's more or less how I size up things. I think Facebook actually did have a meaningful change. I don't think that looking at a stock being off and presuming that the business is the same is the right presumption. I also do think businesses change less quickly than stock prices do. So, there's a lot of nuance for everything, and that's my 2 cents. Somebody was offended that I said that my kid had to stop being a bitch. That person can go fuck themselves. Nothing about how much I care about my family. So as far as criticizing me, the investor, all is fair in love and war. Criticizing me as a human is sort of, you're an idiot, and I actually know the truth. So that's my take on sometimes some of the conversations we have and some of my reactions.
I think you did highlight an important point about there's quotational risk on anything. And do you want to ensure that quotational risk through CTAs, tail risk hedging, cash, maybe tilting some direction, who knows, that may or may not save you that much. Okay. Or do you look past all of that stuff and you just self-insure quotational risk by taking a walk, getting some fresh air, not following every little blip of the market? That's another way to self-insure against quotational risk.
Taking a walk didn't help much when I was down 30% in a quarter.
Well, you're gonna have to walk a little further.
Yeah, it was 26 for what it's worth, but
that's, I mean, if you're going to earn equity returns, you have to be willing to stomach those types of changes quotationally. And if you're right about the business, that it doesn't matter over the longer term. So, but if you are in a situation where you can't stomach that for whatever reason, whether it's institutional imperative, whether it's you just know yourself that like, I can't handle watching my stuff go down that much, whether it's any multitude of reasons, then you should know that, and then therefore do something kind of from an asset allocation standpoint to make sure that you're not going to force yourself into making a bad decision when the pressure does ratchet up at some point, which it will.
Yeah, I think that's right. I mean, for me, I'm managing more or less a static pool. I mean, there's some income coming in, but it's I think it makes more sense to try to own businesses that I can own for a long time than it does to focus on, is this transitory inflation or not? Like, I don't care. I care whether or not people have to pay their cable bill and whether or not they're addicted to nicotine pouches. And I have some degree of confidence that cable companies should be able to raise their, pricing. If that's not true, I need asset allocation to protect me, because like, I'm not chasing shittier businesses in the name of trying to be safe. Like, I'm not going to do that. I will take a swing at the right thing though. I mean, I swung pretty freaking hard at Curate, and that's not exactly, something that people loved and was easy to own. That said, I made like no money, and it cost me a shit ton in opportunity cost.
And mental brain damage.
I do love that business, and I love the people there.
Segue to something else. Did you guys see that Zero Hedge has been accused of spreading Russian propaganda by US intelligence?
Oh yeah, dude, that's old news. That's been since like 2016. I mean, I don't know that they've been formally accused, but they've been
formally accused now.
Yeah, I mean,
by who?
US intelligence, evidently.
What does that even mean?
I don't know. I didn't see that it was US intelligence. That was just a comment that was left here. But I saw the article that they had been accused. I don't know how. Like, what does that mean? Do you get a visit from the CIA?
I've heard this for a long, long time, that they're basically like a Russian propaganda outlet. That may not be like common within finance circles, but I have heard that from people for a very long time.
I mean, but you hear that like anytime that anybody says something that nobody else agrees with, they're always going to be misinformation or propaganda for somebody else, right? There's only two types of information. It's either propaganda or misinformation. There's nothing in between.
Yeah, look, I'm not arguing the merit of Zero Hedge on this program. I'm merely saying that I have heard that in the past.
What if Zero Hedge was just an elaborate ploy to get you to dump all your equities, be long gold, and just make all the weaken financially the opposition?
It's a very.
I mean, if you followed their advice, you probably are relatively weaker over the past decade.
That's the long game.
Yeah, I read Zero Hedge. I think there's a lot of. I like seeing the weird stories. I like seeing the stuff that's not printed anywhere else. I kind of like that about it. I'm on the lookout for like different stuff all the time. Like Zero Hedge had all of the COVID stuff way before anybody else did. I was telling people I came home, I read it in Austin, came home and told my wife to go and buy a whole lot of food, and everybody thought I was nuts.
Yeah.
Zero Hedge helped me there.
I think that they uncover some stuff. I also think that people have said that they're a Russian outlet for a long time.
Yeah,
I have no formal opinion to lend to this particular topic. I haven't read them in a long time.
Yeah. Oh, I read it regularly. I think it's very good, but you got to be, you got to filter everything you read.
I don't read the news for the most part either, for what it's worth.
Well, most stuff, everything you read is bullshit. I just want different perspectives on the bullshit.
Yeah.
I read earnings transcripts and expert interviews.
So all those wrongs cancel out to become one right. Is that how it works, Toby?
That's the theory anyway. I don't think it works that way, but
no.
Two wrongs make a right. I think that's how it works, right? Throw some questions in, dudes. Hey, Bill, do you have a suggestion on how I can learn about debt structure?
Not really. I mean, yeah, I think you just got to pick up the credit documents and start reading and then ask questions. If you don't, I mean, it's boring work, but it's important stuff. On Curate, I had to ask people that actually work in debt whether or not I was missing something. I mean, there's so many different tranches of debt that, like, searching for a negative can be very annoying in reading debt packages. So I had to check my work and, we'll see. Who knows whether or not I was right or wrong in the long term.
Do you think
I don't have food saved up from 2 years ago. Thanks for that question. Yeah. I don't have food. I use this I don't use the just in time anymore. I have this inventory and I turn the inventory.
Actually, sorry, I somewhat lied. I've recently been reading Nothing But Net. That's a pretty interesting book if you want to get the view of a tech analyst.
What's that about?
Revenue growth. You want revenue growth.
Ah, this whole time.
I mean, that's what a lot of it's about.
JT, what's your background? And are you going to be running the sideline for the University of Texas shortly?
Yeah, it looks like it.
You're a linebacker coach.
This is a little hike last week that I was on, so I just took a little picture because I like to keep track of my favorite little places to go walk and listen to the Berkshire AGMs on audio.
Yeah, are social media companies disrupting harmony and inviting too much censorship? Yeah, I think they are. I think the risk that they run as they get into the publishing, where they become responsible for what they're saying.
Section 230 removal.
Yeah.
I'll tell you what, if that happens, Facebook's going to be the only one left. Because nobody else has the scale to actually. I mean, Facebook doesn't even have the scale. Yeah.
Yes, Facebook spends more on some weird stat, like Facebook spends more on compliance than Twitter generates in revenue, something weird like that.
Yeah. I mean, they put a lot of resources into it and they don't, I mean, you privatize the internet, you get the shit that the internet comes with.
Why is Mugger using margin to buy Baba? I don't think that he has used margin specifically to buy Alibaba. I think that they have margin in that account. One of you guys was talking about that a little bit, I think.
Yeah, I don't know.
JT, do you know
that? No idea.
Charlie
doesn't take my calls.
Yeah.
He takes JT's.
Yeah.
It's true.
Not gonna respond to that. I don't confirm or deny. My understanding was that there was already margin used in their account, so it wasn't. I don't think there was like a like for like kind of, we took margin to go buy this particular thing, but I don't know. Do your own homework.
Do you guys read Seth Klarman's most recent letter?
No, I didn't get that one. I would read it.
Yeah, it was out there.
A lot of doom and gloom. Is that?
Well, they've had their best year in like a decade or something like that. I don't know. They're not doing a lot in public equities these days. Most of it's like private.
They do a lot in real estate. I bet they made it rain in real estate.
I find all those letters, I've just read so many letters now that it's very rare that you see something new in a letter. I find they're all, I could have, you could feed all of Klarman's letters into a
algo and then it just spits
and it would have written the same letter. Yeah.
Yeah, true.
It looks like the homie Bill is saying that in the 10Q, it says that Charlie used margin. I have not read the Daily Journal 10Q. I don't care very much what it has to say, to be perfectly candid.
Oh, he borrowed 37 million in the latest Q to buy Barber. That's aggressive.
I mean, the dude obviously thinks the stock's going up and his other securities are not gonna implode. Otherwise, he's got himself in a margin call.
Yeah, that's aggressive.
Well, Charlie's never not been aggressive.
That is true.
Pounce vigorously, I believe, was his advice.
I mean, I don't know his thesis, so I don't know why he's so comfortable. I mean, look, my thoughts on why he's using margin, I don't know. The dude is Charlie Munger. He's a savant. I'm an idiot. He probably sees something I don't.
I was thinking about that the other day when I just happened to come across in one of the AGMs, and Munger was actually talking about Buffett and like how weird he is to everybody, and he's like, he asked, like, hey, Warren, didn't you try to buy a town when you were 21 years old? And Warren's like, oh yeah, I did try that, but it didn't go through. But none of us were trying to buy a town when we were 21 years old. Like, this guy is just different level than everybody. And so to think like, oh, I'm going to be the next, come on, get out of here with that.
The other thing is the thing about Daily Journal, this is the risk with any corporation that somebody's got control of. Like, if you don't like what he's doing, you can sell the stock. But expecting Charlie not to be Charlie, I don't think is very fair. And Charlie's going to do whatever Charlie wants to do. And if you disagree, sell. I probably would have sold when they had all that shit with the Buffalo News. I probably would have been like, what are these two guys doing? Incinerating cash on fire, fighting a newspaper war. You don't like it, leave. If you trust them, trust them.
Yeah,
the beauty of liquidity.
The Chinese accounting for Alibaba. There's some websites out there that track Alibaba's filings that are hilarious and make it hard to invest in Alibaba, even though optically it's cheap. I don't know. Charlie's got some additional help there from Lilu, though, I'm sure. So it's probably a good trade.
Yeah, right. I mean, that's really what I think it boils down to is you've got Lilu and Charlie on one side, and then you've got me in an office opining on it. I'll take Lilu and Charlie.
Can always ask the question at the Daily Journal meeting that's coming up soon.
Tomorrow.
How do you coming dial in?
What's that?
Is it live or is it dial in?
I think it's on Yahoo broadcast, but I don't know how you would try to ask a question.
I'm sorry if I was curt with the Daily Journal thing, but I just don't know. And I just really do think any controlled company, you're at risk of the person that's in the driver's seat go in a direction that you don't want to go.
What's up with the turnover in Burry's portfolio? So many moves. Yeah, I don't know. I don't hate it though. It's how I do it.
He's always had a lot of. Well, I shouldn't say that, but I do think he turns things over a fair amount, doesn't he?
You know that deeper value stuff. When it gets to value, you got to punch it out. You can't sit on it, round trip it. Lilu got destroyed on PDD and Facebook. Facebook's interesting, right? How much do you guys hate Facebook, the stock?
I mean, I'm long it, so I don't hate it, but I also think that people that don't understand what's going on there are completely fucking blind to the change that's going on there.
Were you long before or after the dump?
Before.
Yeah, it's kind of interesting now, right? I don't know.
I thought it was interesting before, but I do think that fundamentally,
deep value before, might be deep value now.
I don't think value and tech is a great combo. Just generally,
definitely in the past.
Okay. Well, I mean, if you have statistical proof, I'm merely diarrheaing my head. But
I think you just about can't exclude it from a technical perspective. I mean, from a not technical, statistical perspective.
Yeah, I mean, look, I think that you got to have a view on what short form video does to the inherent nature of the platform. What do you mean? It's a social platform, and
we do it in different ways, mate. I don't have views on all of that stuff. I'm never going to figure that stuff out. It's too hard. If it gets too cheap, I'm just going to buy it.
How do you? Yeah. Okay. Well, that's fine. We have different ways of operating.
Let it ride.
It's the difference between basket buying and
right.
idiosyncratic buying.
That's right.
It's okay.
I think a lot of this stuff is unknowable. And I just think that, it's a little bit like macro, like it's fun to talk about, but it shouldn't really impact investment decisions.
I don't think that doing calls with advertisers and have them tell you that stories monetize different than news feed, and that the reason is because the way that people click through it. And if you look at human behavior scrolling the news, I don't think that's unknowable. I think that's just doing the work.
But that might be why it's cheap,
Okay. I mean, sure. But you don't have a view on it. The whole point is you have a statistical idea. So you opining on it and just throwing it away is, I know. So it almost, I don't mean this disrespectfully, but the way you're treating this, it's almost as if it's not even worth talking about.
Well, let's talk about it.
I was trying, but if it gets too cheap, you'll buy it. That's the discussion.
I think that's kind of like, we've already established that that's my approach.
Yeah, I have no idea how you determine what is cheap and what is not without these questions being answered in a discretionary portfolio. If you want to outsource it to a bunch of bets, I totally understand that, but then it's not worth having a business discussion over. It's a statistical conversation.
Well, you're trying to handicap the future based on dynamics that are happening today. Toby's looking backwards at what's already happened and assuming some reversion to the mean somewhere. And both of you can be right, and both can be smart ways of doing it. It just doesn't necessarily have to.
I think what it is for me, I can tell you, I'm not trying to be too flippant here because there's a lot of work that goes into the background, but the idea is that it has been historically a good business, and that's all observable quantitatively, right? It's now priced too cheaply if it sustains what it has done in the past. It's now priced too cheaply, even if there's a pretty big diminution in its historical performance. If it's now going to completely revert to the mean, then it's too expensive. But if it's going to it's got a long way to go before it becomes too expensive at these prices. So that's the way that I think about it. I think if it does anywhere near what it has done in the past, with a very wide range, it's too cheap here, and it'll probably do okay. With a long enough time frame, 5-year, 10-year time frame. That's what I think. That's what I think about it. As to diving down into the detail of the business part of it, I question whether anybody can really figure that out because it all moves so quickly. And maybe that's why you don't want to be in tech. But that's my position without being too flippant. All right, fellas, that's time. This is fun.
Dead air.
I question how you can invest without questioning that stuff. So, but statistically cheap bets is the way you can do it.